Hey everyone, and welcome to the channel. If you've been hearing all the buzz about cryptocurrency and are curious about how to get started with trading, you've come to the right place. Today, we're breaking down everything you need to know, from the absolute basics to some strategies that can help you navigate this exciting market. We're going to demystify crypto trading step by step. So, grab a notepad and let's dive in. First things first, what exactly is cryptocurrency? Think of it as digital or virtual money that uses cryptography for security. Unlike traditional currencies issued by governments, like the US dollar or the euro, most cryptocurrencies are decentralized. This means they aren't controlled by any single entity, like a bank or a government. Instead, they operate on a technology called blockchain, which is a distributed public ledger of all transactions. The most famous crypto is, of course, Bitcoin, but there are thousands of others, often called altcoins, like Ethereum, Solana, and Cardano. Each has its own unique features and purpose. So, why are people so interested in trading them? Well, the crypto market is known for its volatility. Prices can swing dramatically in very short periods. For traders, this volatility can present opportunities to profit from price movements, both up and down. However, and this is a big however, it also comes with significant risk. It's crucial to understand that you should never invest more than you are willing to lose. This isn't a get-rich-quick scheme. It's a market that requires education, strategy, and a cool head. All right, now that we have the basics down, let's talk about how you can actually start trading. Your first step is to choose a cryptocurrency exchange. An exchange is an online platform where you can buy, sell, and trade cryptocurrencies. Think of it like a stock brokerage, but for digital assets. There are many exchanges out there, and they can be broadly categorized into two types: centralized and decentralized. Centralized exchanges, or CEXs, are the most common and user-friendly for beginners. Platforms like Coinbase, Binance, and Kraken are popular examples. They are operated by a company that acts as a middleman to facilitate trades. They typically offer high liquidity, meaning it's easy to buy and sell, and provide customer support. The downside is that you have to trust the company with your funds, and they require you to go through a Know Your Customer, or KYC, process, where you verify your identity. On the other hand, you have decentralized exchanges, or DEXs, like Uniswap or PancakeSwap. These operate without a central authority, using smart contracts to execute trades directly between users on the blockchain. They offer more privacy and control over your funds, but they can be more complex for beginners and might have lower liquidity for some assets. For your first foray into crypto trading, starting with a reputable centralized exchange is usually the easiest path. Once you've picked an exchange, you'll need to create an account and secure it. This is incredibly important. Set up a strong, unique password and, most importantly, enable two-factor authentication, or 2FA. This adds an extra layer of security by requiring a second form of verification, usually a code from an app on your phone, in addition to your password. Security in the crypto world is your responsibility. After setting up your account, you'll need to fund it. Most exchanges allow you to deposit traditional currency, what we call fiat currency, like dollars or euros, using a bank transfer, debit card, or credit card. Once your account is funded, you're ready to make your first trade. It might seem daunting, but the process is usually straightforward. You'll navigate to the trading section, choose the cryptocurrency you want to buy, like Bitcoin, enter the amount you want to spend, and confirm the purchase. Congratulations, you now own cryptocurrency. But holding crypto is one thing, trading it is another. Let's get into the core of it. The fundamental principle of trading is simple: buy low, sell high. The challenge, of course, is figuring out when the price is low and when it's high. This is where market analysis comes in. There are two main types of analysis traders use: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a cryptocurrency based on its intrinsic value. You'd look at the project behind the coin. What problem does it solve? Who is the team behind it? What is its technology, its roadmap for the future, and its community like? You'd also consider broader economic factors. This approach is about understanding the long-term potential of a project. If you believe a crypto has strong fundamentals, you might decide to buy and hold it for a long time, a strategy often called hodling. Then there's technical analysis, or TA. This method is all about studying price charts and market data to predict future price movements. Technical analysts use various tools and indicators. You've probably seen those complex-looking charts with lines and patterns all over them. Those are the tools of the trade for a technical analyst. They look for patterns like head and shoulders or triangles, and use indicators like moving averages, the relative strength index or RSI, and Bollinger Bands to gauge market sentiment and identify potential buy or sell signals. Let's briefly touch on a few key technical indicators. Moving averages smooth out price data to show you the trend direction. For example, if the price is consistently above its 50-day moving average, it's generally considered to be in an uptrend. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is often used to identify overbought or oversold conditions. A reading above 70 might suggest the asset is overbought and due for a correction, while a reading below 30 might suggest it's oversold and could be a buying opportunity. Combining both fundamental and technical analysis can give you a more well-rounded view of the market and help you make more informed trading decisions. You don't have to become an expert overnight, but learning the basics of both will give you a significant edge. Now, let's talk about managing the most important factor in trading: risk. Risk management is what separates successful traders from those who lose their money. The number one rule is, as I said before, never trade with money you can't afford to lose. The crypto market can be unpredictable. A key tool for managing risk is setting a stop-loss order. A stop-loss is an order you place with your exchange to automatically sell a cryptocurrency when it reaches a certain price. This helps to limit your potential losses if the market moves against you. For example, if you buy Bitcoin at $30,000, you might set a stop-loss at $28,500. If the price drops to that level, your position is automatically sold, preventing further losses. It's your safety net. Another important aspect of risk management is position sizing. This means deciding how much of your trading capital to risk on a single trade. A common rule of thumb is to risk no more than 1 to 2% of your total trading portfolio on any one trade. This way, even if you have a string of losing trades, you won't wipe out your account and will live to trade another day. Diversification is also a strategy, but be careful. Don't just buy a bunch of random coins. Diversify across projects you've researched and believe in. Let's also discuss two common trading strategies: day trading and swing trading. Day traders open and close positions within the same day, aiming to profit from small, short-term price fluctuations. This is a very active, high-stress strategy that requires constant attention to the market and a deep understanding of technical analysis. It's generally not recommended for complete beginners. Swing trading, on the other hand, involves holding positions for several days or weeks to profit from larger market swings. Swing traders still use technical analysis to identify entry and exit points, but they are looking at bigger trends. This approach can be less time-intensive than day trading and might be a more suitable starting point for new traders. Beyond these strategies, it's vital to develop the right trading psychology. The market is driven by fear and greed. When prices are shooting up, the fear of missing out, or FOMO, can lead you to buy at the top. When prices are crashing, panic can cause you to sell at the bottom. Successful traders learn to control these emotions. They stick to their trading plan, follow their risk management rules, and don't let a single trade, whether it's a win or a loss, dictate their next move. Trading is a marathon, not a sprint. Another crucial topic is where to store your crypto. While keeping a small amount on an exchange for active trading is convenient, it's not the most secure option for long-term holdings. Exchanges can be hacked. For better security, you should use a personal crypto wallet. There are two main types: software wallets, also called hot wallets, and hardware wallets, or cold wallets. Software wallets are applications you can install on your computer or phone. They are convenient for frequent transactions, but are still connected to the internet, making them potentially vulnerable. Hardware wallets are physical devices, like a USB stick, that store your crypto offline. This is the most secure way to store your assets because it keeps them isolated from online threats. Devices from companies like Ledger and Trezor are popular choices. When you set up a wallet, you'll be given a recovery phrase or seed phrase, which is usually 12 or 24 words. Guard this phrase with your life. Anyone who has it can access your crypto. Never store it digitally or share it with anyone. As you get more comfortable, you might want to explore the wider crypto ecosystem. There's DeFi, or decentralized finance, which aims to rebuild traditional financial systems like lending and borrowing on the blockchain, without intermediaries. There are also NFTs, or non-fungible tokens, which are unique digital assets representing ownership of items like art, music, or collectibles. The world of crypto is constantly evolving, with new innovations emerging all the time. Staying curious and continuing to learn is key. So, to recap for all the beginners out there, start by educating yourself on the basics. Choose a reputable exchange, secure your account properly with 2FA, and start with a small amount of capital you are willing to risk. Learn the fundamentals of both technical and fundamental analysis. Always use risk management tools like stop losses and proper position sizing. Develop a trading plan and stick to it, controlling your emotions. And for long-term holdings, use a secure hardware wallet. Remember, there's a steep learning curve in crypto trading. You will make mistakes. The goal is to learn from them and not let them take you out of the game. Start small, be patient, and focus on continuous learning. There are countless resources online, blogs, podcasts, and YouTube channels like this one that can help you on your journey. Don't just follow random calls from influencers on social media. Do your own research. This is a common phrase in crypto, DYLR, and it's probably the most important piece of advice. Your financial decisions are your own responsibility. This might all sound like a lot, and it is. But by taking it one step at a time, you can build a solid foundation of knowledge and become a more confident and responsible crypto trader. The journey is challenging, but it can also be incredibly rewarding. Thanks so much for watching today. I hope this guide has given you a clear roadmap to get started in the world of cryptocurrency trading. If you found this video helpful, please give it a thumbs up and consider subscribing for more content just like this. And if you have any questions, drop them in the comments below. I'll do my best to answer them. Stay safe, trade smart, and I'll see you in the next video.